Well, hi everyone. Welcome to Buffett and Beyond Research. And remember, if you want to live on the beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And this week we're going over Mastercard and American Express because the question was, which company is better company or a better company in order to invest in? And we're going to look at those two stocks and compare them because one of those stocks graces our growth portfolio. Now let's look at a quick description of what Mastercard does, and we all know what it does and what it is. Global leader in electronic payments, serves as a processor, franchisor, and advisor to about 25,000 financial institutions. In support of their credit, debit, and related payment programs, revenue is derived from both transaction volume and dollar volume. Has about 21,000 employees. All right, let's look at American Express. Well, we know what they do too. Leading global payments network and travel firm. So look at this. It's more than one company within the American Express umbrella. So it's global payments, just like MasterCard, but it has a travel firm associated with it. It was established in 1850, incorporated in 1965. It's a world leader in providing charge and credit cards. Now, 77,300 employees. What was MasterCard? 21,000 employees. So American Express is almost 4 times bigger than Mastercard is. But don't forget, it's more than one company. It's a travel firm. A lot of people work in those travel offices. All right, let us look at two side-by-side comparisons of the clean surplus return on equity. Now, when you look at this, think of your bank account. What do you do over here? Now, don't associate these numbers with any one of these companies. But what we do is we put money in the bank, and we want to put it in the bank that's giving us the highest interest rate. And if we leave that money in there each year, then the bank account goes up. So that's our net income. In other words, this is net income ongoing total. And so we look at this, or you can call them earnings, because net income is the clean surplus earnings, and we want to see our bank account grow. But we also want to know how much interest we're getting from each of these banks, Bank American Express and Bank Mastercard. Well, we look at the return on equity because think about this. If you look at a bank and the bank is giving you 7%, your return on equity is 7%. So we break down stocks in the way that we would look at a bank, where other institutions, research institutions, do not do that. They look at it in a different way. They use traditional accounting return on equity. We use something different, which is explained in our literature and our books, of course. Now, so Bank American Express, bottom line, Bank American Express is, for 2024 is expected to pay us 10.7%, where Bank Mastercard is expected to pay us double that. So look at these numbers here, and we can see that MasterCard, with the exception of 2020, what was 2020? Yeah, COVID. Even with so many stores shut, this company still brought a lot to the bottom line. Now, the average stock has a clean surplus return on equity of about 13%. So we want to put stocks with return on equity greater than 13%. If you're thinking banks, we want banks that are paying us higher than 13% because the average bank is paying 13%. Well, the average stock is paying us 13%. And when we look at the clean surplus of MasterCard, we're looking at over 20% and averaging 21, 22, 23% over the years. Very, very nice. Where American Express, yeah, it's averaging 10, 11% over the years. So Bank Mastercard is paying us twice as much as Bank American Express is. And that's how you compare stocks, folks. So guess what? If we put money into Mastercard, we should see Mastercard grow faster, and I'm talking about stock price, grow faster than American Express. Now, let's look a little closer at Mastercard. And we can see here, what I want to show you is 2018, 2019, it was making about on average $7 a share. Now, what's it expected to make for 2024? $14, or almost double that, or actually just about double that it made in between 2018 and 2019. Now, we'll keep those numbers in the back of our heads because we're going to see them again, and that will dictate the possibility of a rise in the value of this company as far as the stock is concerned. Clean surplus return on equity, we already saw that it's above 20%. And I want to go straight over here to years to pay debt. Now, years to pay debt on Mastercard, 2.2 years. And what does that mean? If a company takes all the money it's making and puts it back into itself in order to just pay the debt, how many years would it take? Buffett's rule of thumb is 5. Our rule of thumb is about 3. So Mastercard could pay off its debt in 2.2 years. Let's go back to American Express. American Express down here, years to pay debt, that's 6. That's above Buffett's average and double what we want to see. We want to see a company pay off its debt a lot sooner, or be able to pay off its debt a lot sooner than that. That means if interest rates go up, then this company, American Express, has a harder time making the interest payments on its debt. So that's why Mastercard, let's go there again, Mastercard with years to pay debt 2.2, much better than American Express. Okay, let's compare these stocks and how they've done over the past 1 year. So this is 12 months. Black line is the S&P 500. Blue line is Mastercard, returning about 15%, while American Express is returning about 9%. So that's a big difference in here, folks. That's just over 1 year. Let's look over 5 years. Over 5 years, again, black line is the S&P 500. Mastercard making about almost 100% return over the past 5 years. That's 20% a year. Doesn't that coincide with the clean surplus return on equity? Yeah, they are related within 80%. So when we look at American Express, what has it made? Maybe about 50%. So we're looking at Mastercard returning double the amount that American Express did. Now let's go back to a slide and look at something. Yeah, when we look at the clean surplus return on equity, we can see that Mastercard is returning about double. And when we're talking about the return on equity, returning about double than American Express. And then when we go to see how the stock has performed over the past 5 years, we can see that Mastercard is earning, or the stock price has gone up about double that of American Express. So that clean surplus return on equity that we looked at before, just now actually, really indicates what a stock will return in the future as long as it keeps doing what it's doing. And Mastercard is doing twice as well as American Express. Yeah, it's that simple, folks. So, folks, this is what we're looking at. We expect Mastercard to continue making about double, and I'm talking about stock price, about double the return of American Express as far as price-wise, because it's making twice as much and putting more back into itself in order to grow. So that's why we like Mastercard over American Express. So, folks, yeah, Mastercard is the stock that's in our growth portfolio, where American Express should be in somebody else's portfolio.